Celsius Holdings has been on an absolute rocket ship lately. And in their Q3 2025 earnings update, their CFO, Jared Langans, basically pulled back the curtain on the numbers behind this incredible run. So we're going to break down the key highlights from his report, slide by slide, to really see what's powering this growth machine. Let's get into it. And we're starting with a number that just makes you do a double take. 173% year-over-year revenue growth. That's just staggering. We're talking $725 million for the quarter. But a huge number like that just leads to the next question. Where in the world is all that growth coming from? So here's our game plan for today. We're going to start by tearing apart that revenue number. Then we'll get into the margin story, how much money they're actually making. After that, we'll see how they're investing back into the brand, shoring up their finances. And finally, we'll figure out what the CFO means when he says the next quarter might get a little noisy. Okay, first up, let's deconstruct that massive top-line number. How in the world does a company get to a $725 million quarter? Well, it's really a story about their whole portfolio firing on all cylinders. Now, this is where it gets really interesting. The core Celsius brand, still growing strong at 44%. Alani Nu, which they just bought, it nearly doubled its revenue. That's crazy. And Rockstar Energy, it shipped in about $18 million in its very first month. But, that 44% number for the main Celsius brand, it kind of raises a question. And that question is, are we kind of looking at a tale of two different growth rates here? Because the numbers the company reports in its revenue and the numbers we see from the scanners at the actual stores, well, they seem to be telling slightly different stories. So what's the deal? And here's that gap, plain as day. The company is reporting 44% revenue growth for the Celsius brand, but the scanner data, what you and I are actually buying at the checkout, only shows 13% growth. That is a pretty big difference. So how do you explain that? Well, it turns out it's not just about what's being sold in stores, it's also about what's being shipped to distributors. The gap really comes down to three things. First, some big inventory moves with their distributors. Second, they've been running more promotions. And third, they're expanding internationally, and those sales don't even show up in the US scanner data. So that explains it. Okay, so they're selling a ton of product. But here's the real question. Are they making good money on each can? Let's jump into our second section and see how their profitability is looking with all this crazy expansion. And the answer is a resounding yes. A gross margin of 51.3%. To put that simply, for every dollar they make in sales, they're keeping over 51 cents to cover their other costs and, of course, their profit. That is a really, really healthy number, especially for a company that's growing this fast. But margins are always a balancing act, right? On one side, you have things helping them out. Their sheer size is getting them better deals on materials, and they had a good mix of products and sales channels. But on the other side, they're getting hit by tariffs, and the new brands they bought, Alani Nu and Rockstar, just naturally have lower margins for now. It's a classic push and pull. All right, let's talk about spending money. You know what they say? You got to spend money to make money. And aggressive growth needs aggressive investment. Let's see how Celsius is strategically using its cash to keep this momentum going. The company is consistently pouring about 20% of its revenue right back into sales and marketing. This isn't just a cost on a spreadsheet. It's literally the fuel for their growth engine. It's what funds campaigns like Celsius Live Fit Go and keeps the brand right in front of all of us. Now, you might have looked at their income statement, seen a massive $247 million expense, and thought, whoa, what is that? But here's the key. Don't panic. This is just an accounting move. It's related to the Alani Nu deal, and their partner PepsiCo is footing the entire bill. So for Celsius, it has zero impact on their actual cash. And check this out. This chart shows they're getting more efficient. Their general and administrative costs, the basic cost of keeping the lights on, have actually shrunk as a percentage of sales from 9% last year down to just 6% this year. That means they're getting bigger and leaner. That's a powerful combination. So, growth is flashy, but a strong foundation is what really matters for the long term. Now we're going to see how Celsius is making sure its financial house is in order for the future. Right after the quarter officially ended, the company made a really big move. They paid down $200 million in debt. This shows a serious commitment to being financially disciplined, even while they're spending big to grow the business. And the payoff for that move, it's pretty direct. They're going to save a cool $20 million a year in interest payments, and that starts in 2026.
That's money that can now be plowed right back into the business year after year.
So what this all boils down to is a really clear, simple plan. The CFO laid out 3 main priorities. Keep investing in the brands to keep them growing, find all the efficiencies from their new acquisitions, and just keep making the balance sheet stronger. It's a focused, no-nonsense strategy. And finally, let's look into the crystal ball. The CFO was really transparent about setting expectations for the next quarter, which he described as being potentially noisy. So let's unpack what he means by that.
Think of this timeline as the journey ahead. They just had a fantastic Q3. Q4 is going to be the get your hands dirty quarter. Lots of heavy lifting to integrate the new brands, and that's going to create some short-term pressure. But the whole idea is to come out of it in early 2026, ready for the next big phase of growth. So where's all this noise going to come from? Well, it's the friction that comes with a huge transition. You've got the costs of folding Alani Nu into the Pepsi system, some tricky timing with year-end promotions, plus extra freight costs and tariffs. It's basically the messy but totally necessary part of getting bigger. And that really leaves us with the big question. Celsius has proven it can grow at a mind-boggling speed, all while staying profitable and cleaning up its finances. The challenge now is to manage all the short-term headaches of these huge acquisitions. Can they navigate this noisy quarter and set themselves up for an even bigger 2026? Well, we're definitely going to be watching to find out.